This will be an introduction to the time value of money. It is one of the most important concepts that we have in finance, and we're going to use the methods that we develop in this section in order to understanding many different investments and financing arrangements that businesses have. A thorough understanding of this material will be critical in understanding the remaining sections of this course. Before we begin, it's important to note that we have calculated a percentage change, and that is not the same as the interest rate that we are going to solve for in our time value of money calculations. Interest rates used in our time value of money calculations are going to be a rate that we earn some time period, a day, month, quarter, and often a year. A percentage change is going to be a change in value over the entire life of the investment. That could also be over some short amount of time or some longer time. It's a total change, not an increase earned per some time period. The interest rates we solve for in this section are a rate earned or paid per some time period or some periodic rate. This is an example of a very simple series of cash flows. What we should know is that time 0 is today. Time 1, 2, and 3 are also listed. Time 1 is at the end of the first time period, and unless otherwise noted, we assume that the cash flows will always occur at the end of the time period. CF is going to be an abbreviation for cash flow, and our R is going to be the rate that we earn per some time period. We'll see that there is a subscript below CF3, and that denotes that it occurs at time 3. It is not a mathematical operator. You are not raising anything to the third power. You are not multiplying it times 3. It's just a way for us to identify that that cash flow occurs at time 3. Our present value is going to be a current value of some future cash flows discounted at some appropriate discount rate, which we will denote with an R. Our present value is going to be the value at time 0 on a timeline. In order to find our present value, we would say we would discount the future cash flows to determine that present value or the value today or time 0. Our future value can be an amount some investment is worth after one or more time periods. So for example, if we invested something today, we would call that the present value. And if we earn interest for the next 10 years, for example, if we put money into the bank and kept it in there for 10 years and earned interest, then the amount that we have in the future will be our future value. It is going to be our money or a cash flow on a timeline at some point in the future. In order to determine our future value, we use compounding. Our interest rate, or our R, is going to be the rate of growth for an investment. Depending on the content, it could be known as a discount rate, our cost of capital, an opportunity cost of capital, a required return, a required rate of return. The terminology is going to depend on when we're using that. A cash flow is simply a dollar amount that goes from one party to the next. For example, it could be from the bank to you when they pay you interest, or it could be from you to the bank when you borrow money for a loan. A mutual fund, which is just a way for us to pool investment resources together in order to save for retirement. From your customers to you, or from a company to its owners, we would call those dividends. And cash flows can be either a lump sum, which is a single payment or one cash flow. So if we see a lump sum, that means it's a single payment. Or an annuity, where we say that an annuity is a finite series of equal payments at regular intervals. And then there is a third option where we might have unequal cash flows, where we have a cash flow in the future for $100, and after that $200, in the third year $300, and the fourth year $400. And so we'll look at different examples for each of these. In order to set up our timeline, normally we'll put time across the top, and time could be years, quarters, days, or some amount of time, months, weeks, whatever it needs to be for that particular exercise. Cash flows will normally be listed below the timeline. In this case, we would say that we have a cash flow of $100 today. And that cash flow could be revenue or sales, our top line number, or it could be net income, our bottom line number on the income statement. It could be an interest payment, which is the cost of borrowing money, or it could be a principal payment, which is the money that we owe whenever we borrow it. One note about compounding. In the simplest examples, we earn interest on a yearly basis So the R, our interest rate, and T, our number of time periods, for the year are the same as they are per time period. In other words, our R and T are the same number for the year. In many cases, our return on an investment would be compounded more frequently than annually. So for example, we may have semi-annual interest that we have to pay, or quarterly interest, or if you borrow money from a credit card, for example, you might have to pay monthly interest, or even in some cases, daily compounding based on our investment. In these cases, we need to make sure our time periods and interest rates are periodic. In other words, if we know that we pay interest every month, and we have to pay interest for 12 months, then our interest rate might be quoted as a per month rate, and our time periods would simply be the number of months that we're going to pay back the investment. Our R is going to be the rate per time period. So in our equations, or when we use our financial calculator, that R is going to be the rate per some time period. A rate that is earned or paid per quarter or per month or per day. In some cases, the rate will be given as a per year rate, and you will have to convert it to a rate per time period. So for example, if you know that you earned 12% per year, and we would have to get that into a monthly rate, you would simply divide 12% by the number of months in a year, or 12% divided by 12, and you would find out that you earn 1% per month. T is going to be the number of time periods, and examples, exercises, or problems will usually make reference to a number of years, and you'll have to convert it. So for example, if you saved money on a monthly basis for 30 years, then what we might say is that you had 360 months in order to save, where 360 is simply 30 times 12. And finally, in some cases, it might be the case that you get an interest rate per year and a number of months that you save or have to pay for, or you get an interest rate per month and the time periods is in a number of years and you have to convert it. So we just want to make sure that both the variables are going to be listed as periodic when it applies. It's important to note that in most examples, unless it's otherwise stated, we will assume compound interest. Simple interest means that you're going to take your money out of the bank. You're only going to earn interest on the original principal or the original amount that you have saved. In other words, you're going to store that money in a shoebox. You're going to take that money out of the bank and you're going to store it for later. Again, in most of these cases, we're going to assume compound interest where you continue to invest. You earn interest on your principal and also interest on our interest. Again, that's going to use our formulas for our time value of money. Compound interest is very important, and it's one of the best ways to make sure that you have enough money saved for retirement. If you have $100 in the bank, at the end of the first year, if the bank pays you 10% under simple interest, you would take your $10 and store that money in a shoebox underneath your bed. And for the second year, the bank would pay you $100 times 0.1 or 10%, another $10. Again, that was for simple interest. For compound interest, you would leave the money in the bank. At the end of the first year, if the bank said they were going to pay you 10% on your $100 investment, you would have $100 plus your interest. So in other words, you would have $100 times 0.1, which is 10%, for a total of $10. So you have your original $100, which is the principal, and now your interest of $10. And if you leave it in for another year, you're going to earn another $10 on your $100, but you're also going to earn 10% on the interest from the first year as well. So you'll get a little bit extra money, in this case, another $1 that you would have earned over those 2 years with compound interest. In our time value of money calculations, we're going to assume we earn compound interest. So we're going to have 5 main inputs in our time value of money calculations. The first one in this table is time. And time is going to be our number of years multiplied by the number of time periods in a year. So for example, if you earn interest every 6 months or twice a year for 10 years, you would simply take 10 times 2 in order to get the number of time periods. In our formula, it's most often going to be denoted by T. In some cases, you might see it listed as N or T times M, where M is the number of compounding periods per year. For example, in this case, if we had interest that was earned every 6 months, M would be 2 because there's 2 6-month periods in a year. And so again, our T times M would be equal to 20. On our financial calculator, it's going to be listed as N. The second variable that we see here is our interest rate, and it's going to be some annual rate divided by the number of time periods in a year. And that's going to give us what we call a periodic rate, or a rate per some time period. In our formula, it's usually going to be denoted as an R. In some cases, it might be R divided by M, again, where M is the number of compounding periods per year, or it also might be listed as I. On our calculator, in many cases, it's I divided by Y, but you also might see those other options depending on the calculator that you use. The third variable in this table is present value. And again, our present value is going to be the cash flow at time 0. It's the price today. If we ever have to solve for a price and time value of money, we're going to solve for the present value or the value today. It's going to be noted in most cases as PV on both our formula and our calculator. And depending on the context of the problem, it may be listed as a C or CF. Our payment is going to be an annuity. It is going to be a finite series, or less than infinity, of equal cash flows at regular intervals. In most cases, it is denoted by PMT for payment. In some cases, again, depending on the context of the problem, you may see C, CF, or INT. Our future value is simply going to be a cash flow that occurs in the future. In most cases, it will be denoted by FV, and again, depending on the context, it may be identified by a C. So again, these are our time value of money inputs, and we will use these inputs for our time value of money exercises.